Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of exploring the basics and future of derivatives markets in 2024. Retail investors. Retail investors are individual traders or small investors who participate in derivatives markets, usually for personal accounts. While they don't have the same financial clout as institutions, their involvement can still influence market dynamics. Diverse strategies. Retail investors often use simple strategies, such as buying options to gain exposure to a particular stock. Others may engage in more advanced strategies, like spreads, to manage risk or enhance returns. Accessibility. With the rise of online trading platforms, retail investors find it easier than ever to access derivatives markets. This convenience has increased participation among everyday investors. Education and resources. Many retail investors rely on educational resources to improve their understanding of derivatives. They seek tools and information to help them develop effective trading strategies. Market sentiment. The collective actions of retail investors can create trends or drive market movements. Their buying and selling decisions, fueled by social media and news, can lead to significant price fluctuations. Retail investors add diversity to the market, showcasing a range of perspectives and strategies. Despite their smaller size, their collective impact can be felt across the derivatives landscape. Understanding these participants helps illustrate the complex web of interactions in derivatives markets. The synergy between institutional and retail investors creates a dynamic environment that shapes financial decisions and market trends. What are your thoughts on the roles of these participants? Regulation and risk in derivatives markets. In derivatives markets, regulation is essential to maintain integrity and manage risks. These markets can expose participants to various uncertainties, so understanding the role of regulatory bodies and the risks involved is crucial. Regulatory bodies and frameworks. Several key organizations oversee derivatives markets, ensuring they operate fairly and transparently. Here are some of the most prominent regulatory bodies. Commodity Futures Trading Commission, CFTC. This U.S. agency regulates trading in futures and options markets. The CFTC's goal is to protect market participants and the public from fraud, manipulation, and abusive practices. Securities and Exchange Commission, SEC. The SEC oversees securities markets in the U.S. This includes certain types of derivatives, especially those linked to securities. European Securities and Markets Authority, ESMA. This European Union authority enhances investor protection and promotes stable, orderly financial markets. ESMA develops regulations that impact derivatives markets within the EU. International Organization of Securities Commissions, IOSCO. IOSCO is a global organization of securities regulators. It establishes standards and promotes cooperation among regulators to ensure market efficiency and investor protection. Basel Committee on Banking Supervision, BCBS. While focused primarily on banking, the BCBS sets standards that affect how financial institutions manage risks related to derivatives. These regulators develop frameworks that include reporting requirements. Entities trading in derivatives must report their transactions to enhance transparency. Capital requirements. Financial institutions face rules on how much capital they must hold against their derivatives positions to reduce systemic risk. Margin rules. These rules require parties in derivatives contracts to maintain sufficient collateral, aiming to mitigate counterparty risk. In summary, regulatory bodies help ensure that derivatives markets operate within a safe framework, protecting participants and the overall financial system. Counterparty risk and market risk. Derivatives markets involve distinct types of risks that participants must manage carefully. Two of the most significant risks are counterparty risk and market risk. Counterparty risk. Counterparty risk arises when one party in a derivatives contract fails to fulfill its obligations. This could mean not delivering the asset or not making payment as agreed. Here's how to manage this risk. Clearinghouses. Many exchanges require trades to go through a clearinghouse, which acts as an intermediary. This reduces counterparty risk by guaranteeing trade completion, regardless of individual parties' financial status. Credit checks. participants often conduct credit evaluations on potential counterparties to assess their ability to meet obligations. Netting agreements. These agreements allow counterparties to offset mutual obligations, minimizing the amount of cash or assets exchanged. Collaterals and margins. Participants are typically required to post collateral or margin to secure their performance under the contract. This acts as a cushion if a counterparty defaults. Market risk. Market risk refers to the potential for losses due to market fluctuations. Since derivatives derive their value from underlying assets, changes in these assets can significantly impact their value. To manage market risk, participants utilize various strategies. Hedging. Businesses often use derivatives to offset potential losses in their underlying investments. For example, an airline may hedge against rising fuel prices through futures contracts. Diversification. Investors can spread their investments across different types of derivatives or underlying assets to reduce exposure to any single market move. Risk assessment models. Many firms use complex models to measure and forecast risk. These tools help participants adapt their strategies in response to market changes. Stop-loss orders. This strategy allows participants to set predetermined exit points on trades, limiting potential losses. Understanding and managing both counterparty and market risks is essential for anyone involved in derivatives markets. By implementing these strategies and adhering to regulatory guidelines, participants can navigate the complexities and uncertainties inherent in these financial instruments. What strategies do you think are most effective in managing these risks? Recent trends and innovations in derivatives markets. The derivatives market is constantly evolving, driven by new technologies and market dynamics. Staying updated on recent trends is essential for participants. Let's look at two significant areas reshaping derivatives markets: technology and cryptocurrencies. Impact of technology and automation. Technology plays a key role in transforming trading and market practices. The rise of automated trading systems has changed how derivatives are traded. Here are a few ways technology is making waves in the market. Algorithmic trading. Automated trading uses algorithms to execute trades at high speeds. This reduces the time needed to make decisions and helps capture market opportunities quickly. Blockchain technology. This innovation enhances transparency and security in transactions. With blockchain, all trades are recorded on a public ledger, reducing fraud risks and improving trust among participants. Advanced analytics. Big data and machine learning help traders analyze market trends. By evaluating large datasets, they can make informed decisions and predict price movements more accurately. Electronic platforms. Online trading platforms have made accessing derivatives markets easier for retail investors. These platforms offer various tools and resources to help users make better trading decisions. These advancements enhance efficiency and lower costs, making derivatives more accessible. As technology continues to evolve, it will likely spur further innovation in how derivatives are traded. Emergence of cryptocurrencies and new derivatives products. The rise of cryptocurrencies has introduced new dynamics in the derivatives market. Crypto derivatives offer unique trading opportunities, but they also come with risks. Here's what you need to know. Growing interest in crypto derivatives. As cryptocurrencies gain popularity, derivatives based on these assets have emerged. Products like Bitcoin futures and options allow traders to speculate on the future price of cryptocurrencies. Increased volatility. Cryptocurrencies are known for their price swings. This volatility can create opportunities for traders but also raises risks. Participants need to approach crypto derivatives with caution. Regulatory focus. As crypto derivatives grow, so does regulatory scrutiny. Authorities are working to establish frameworks that address the unique challenges posed by these markets, ensuring investor protection and market integrity. Innovation in product offerings. Derivatives markets are continuously launching new products. For example, traders can find options tied to specific cryptocurrencies or indices that track multiple digital assets. This diversity allows for more tailored strategies. The emergence of cryptocurrencies and associated derivatives is reshaping the financial landscape. As more investors dive into this space, staying informed on the implications and trends is crucial. What excites or concerns you about these developments? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.